for $330,000, but by the time I pay it off, it'll be $630,000. Why does that have to be like that?
So you can afford the payment?
Profit.
Yeah, really.
But seriously, if I really only paid interest on $330,000,
But you're paying it for 30 years.
It's the time frame. That's why you just
doesn't
pay a
say
little
that.
extra.
I mean, I have to wonder though. I mean, that just, yeah, that just is always.
You can always avoid the interest payment by paying off the amount on that month, right?
You can make additional principal
Right,
payments.
I understand all of that, but that's just, I mean, if everybody, and I'm thinking about now, I mean, for me to have bought my house for that, that's peanuts compared to what our kids, or what the future's gonna be. Is banking gonna continue to stay like that for our children? They'll never, what's gonna happen?
Cost of money. We have shareholders
What's gonna happen
to
to the
satisfy,
future?
and so when we loan money, we have to get the interest.
Ralph, why don't you explain to them how they amortize the loan? Then she'll understand.
Yeah, that's good.
What you borrow over what the interest rate is over the number of months, and that's what you come up with, principal and interest payment. You know, if you have money for 30 years, you're going to pay probably twice.
See,
Yeah,
because
definitely do.
the institution is, and we're in a little different, a little bit different, but the same principle here. In that, when we look at a member or a customer and we say, okay, we're thinking of loaning you $300,000. And of course your credit is checked and your ability to pay and so forth and so on. But it costs money. We have to take that money out of the deposit side and give it to you, and then we're on the hook for that 30 years. But at the same time, the cost of money plus the risk involved in, you know, I mean, what? Just using you as an example, what if you were a bad risk and you defaulted, and all of the other members or all of the other customers now can't count on those deposits over here because we've given it to you over here. So all of that kind of calculates in there, and then that amortization is what really. Yeah, you're right. You almost double what your house is worth.
I mean, I'm glad that I have choices.
And the
so
bummer-
I can change that.
the
You know,
bummer
there
part
are
of that
people
is-
that can't, but I'm glad that I do. But it just always just blows me away when you finally look at what you've done paying for your house.
Well, look in the
Oh,
first
my
5 or
goodness.
6 years, you don't make any
Oh, I
principal
know. I was
payments. It's
talking
almost
about
all
that.
interest.
Yeah, I've shown
But
her
you're
that.
building equity, and you're a homeowner, and
You
there's,
got a
you
tax
know, it's
write-off.
the American way to be a
Yeah,
homeowner.
I know, but it
Possibly
just is.
Just remember, when you're paying that same amount in rent, you
Yes.
might as well just be going.
I'm very grateful at
Yeah,
that,
I
because
mean-
rent is what my mortgage is,
Right.
so it's pretty, yeah, it's hard. I just worry about the kids.
I do
of
too.
Having
Yeah.
generation.
And I think it's hard for kids to stay here that have grown up and lived here and want to
Yeah,
stay
your
here
children
because
have to move away from
it's,
you.
first of
Yeah.
all, finding really good paying jobs. It takes almost 2 incomes to afford a home nowadays.
Yes.
It does.
But I will say that in your business, we've sent a lot of Humboldt grads to your respective institutions, and those are solid careers. So,
They are.
yeah. So.
I met my wife here, the lady that just called.
My
Better in the computer lab.
I'm going to do what Jerry's doing when I retire in a couple of years. I'm going to come back to college. I never had the opportunity, so I'm going to go to college.
In fact, I've got to say, one of my mentors when I first got into this industry is sitting right here on my left. She was one of mine too. She kept me in line. She kind of came to me and said, "You want to do what?"
I was going to say there's a couple of things that everybody hit on, so I'm kind of random with this. When he was talking about why the housing situation is like this, is that because you have a lot of people coming from outside of the community and they're retiring and they're coming, say, from the Bay Area or LA, where it's a lot more expensive there. So when you come here, you know, it's like for me, I'm from the Bay Area, and rent is like for a 1-bedroom house. I'm in a 2-bedroom, and I'm paying less than I would for a small
House.
right. So, and I also think that has something to do with why the housing is so expensive, because you have all these people trying to buy and they're willing to pay more. So that, I wondered how that.
Also, lots of areas, it is very difficult to develop property in Humboldt County now. It's very, very expensive, and there's a lot of red tape to go through. So the developers are not developing the houses as quickly, so it's making the market, there's fewer and fewer houses on the market, so it drives the price up.
Supply and demand.
Supply, exactly.
If I could just say something, I want to let our panelists speak, but on the housing, I've been following that a lot lately, and I think you've got two things happening here. You've got a lot of easy money last few years with low interest rates, and more importantly, you guys used to be the traditional folks where people go to for mortgages, and that's opened up now, and people are going elsewhere, and those other people are perhaps not as responsible, or there's just a lot of the faucet is open, so the money is flowing out there for mortgages, and that's really encouraged a lot of people to increase demand and driving prices up, and everybody's really excited about it. I think that's going to go away big time, and today Ben Bernanke, the chair of the Fed, talked about a substantial slowdown in the housing market. But that's something that I think might correct itself within a couple of years. My own opinion.
It's already started.
It's already started.
We're already starting to see it.
And number two is what Martha said, is restrictions on building, supply and demand. That takes local governments and county governments to allow people to build. And there are some papers out there where they've looked at, not Humboldt County, although that'd be very interesting to look at, but areas like along the coast of California, other areas further south of us, and in New York and stuff. And in some areas, the estimate is that prices are about 20 to 40% higher on account of land use restrictions. And I don't know if that's going to go away or not, but we are paying, I think it's reasonable to assume Humboldt County is in that, maybe perhaps 20 to 40% more because of our restrictions on housing. And it's that might affect a lot of people in here, a lot of the younger folks in the future. It wasn't always the case. California wasn't always this expensive 30 years ago. It's gotten a lot more expensive over the last 30 years.
She makes a salient point, though. We are seeing a lot of retirees from larger metropolitan markets taking that tax-free gain out of their overinflated houses and coming up here to pay something that they think is very meaningful. But to us, the folks that are local, is maybe a little high. So that does tend to keep the prices up there, too.